A quick rundown of the working capital and how it affects our cash flow from operations. See, the non-cash working capital changes in cash flow from operations, we take the working capital effect in this way. Why I said non-cash? Because the cash component of the cash balances have already been included in the cash flow statement. So if we say, let's take the example of Poshak Limited. We discussed in Poshak Limited, we notices that in financial year 2020, the inventories of the company had declined by 1.64 crores. It means that in financial year 2020, the company sold goods by using its existing inventories and received cash for the same. Therefore, reduction in inventories is a cash inflow, and accordingly, that rupees, that 1.64 crores has been added in the calculation of cash flow from operations. So this is just another way of looking at the decrease in inventories. When we say that the inventories have declined, that basically means that we have basically used our existing inventories to make sales during the year. Another way to look at trade receivables, as we notice in the Poshak Limited, the trade receivables had declined by 6.29 crores. It means that during that year, company did what? Company collected money from its debtors or account receivable or customers. That is why a reduction in trade receivables is a cash inflow for Poshak Limited. In trade payables, we notice that the trade payables have increased by almost 3 crores in the financial year 2020. It means that during the year, the company will get more goods from its suppliers for which it has not yet paid them. So, what has that resulted in? It has effectively resulted in delayed payment for the goods and the future. Right? So, this is how working capital can be interpreted when we are talking about cash flow from operations. Provisions. What are provisions? So, provisions are basically non-cash expense. When a company believes that it might have to pay something in future. So, we recognize those expenses in income statement today itself because we are basically making accounts or making our books in a judicial way, in a conservative way. So, the cash outflow might not have happened because these are just provisions. Therefore, just like in case of non-cash expenses like depreciations, provisions are non-cash expenses also. And they are added back to derive cash flow from operations from their taxable income.